Good afternoon, everyone, and thank you for joining us on this Saturday afternoon. We hope that you enjoy the income tax tips and strategies for Form 1041 and Decedent Heir Beneficiary Form 1040. I did tailor this down for a 30-minute discussion. My contact data is there at the bottom, and my LinkedIn is at the very end of the PDF. I hope you're going to enjoy what we're going to talk about here and that it is useful to you. I use my CP continuing professional education course disclaimer in here instead of drafting a custom one. And let's get started with the first topic, a basis. What I find out there is that many of our clients and taxpayers and lay people find it very difficult to find their records. They purchased real estate back 20, 30, 40 years ago. We had a specific situation involving a client setting up a trust. And one of the questions we got into was what was the basis of the original real estate that went in? Also, we had the qualified appraisal rules in that situation too. As I started to look down the appraisal, it did not appear to meet the rules that I read in the regulations. And the qualified appraisal rules, anytime you have a gift tax return or you have a non-cash charitable contribution, IRS talks about this in the non-cash charitable contribution form 8283. They also talk about it in the reg, the 170 reg that deals with that issue. And it's important to have proof of your basis. You're going to sell things over time, and having proof of that basis is ultra critical. Yes, IRS has a publication 551, and IRS publication 551 deals with basis, but the first thing is of course, what everybody wants, which is the basis step up, right? By the way, basis can step down as well under the statute. Title 26, by the way, is the United States Codes of Laws. If you want to read them for whatever reason, Cornell University has a online tax law library online for free, Cornell University. There's also a website called Legal, 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 bit, stream.com, legalbitstream.com, and that also has ways to read tax laws if you're interested in reading these sorts of things. Basis step up or down has been preserved under the Tax Cuts and Jobs Act law, and that is important to know. Community property has a very interesting aspect to it. If you hold assets in community property, both halves of the community property step up or step down at the first death, when the first person dies. Whereas in a common law jurisdiction like Florida, if you have a joint tenancy created after what we call the Gallenstein rule after 1976, you have a bifurcated basis, right? So that's an important distinction. Now, a lot of people say, if I move from Louisiana, I teach still in Louisiana. I used to teach in other community jurisdictions. I still teach in the state of Washington, which is a community jurisdiction. If you move to Florida and you go to see an attorney in Florida and you preserve your community property rights under Florida's adoption of the Uniform Disposition of Community Property Rights at Death law, can you get the code section 1014B6, the both halves stepping up or stepping down at the death of the first spouse? And the answer is yes. And that's why it's really important, if you're moving from a community jurisdiction like a California or Arizona or Washington State or Louisiana, which is a unique jurisdiction, it's Napoleonic Civil Code jurisdiction. If you're moving to Florida, it's important to visit with a lawyer in the common law jurisdiction to figure out whether or not you want to avail yourself of community property. And a lot of what I call Ozzie and Harriet marriages, long-term marriages, it's very common that the husband and the wife view that as a marital long-term partnership, and therefore they want to get both halves to step up, and they like the idea of community property, the fact that one half is controllable by each from a state law perspective, and they like that kind of idea, which is great if they like that idea. We lawyers here in Florida, we know about this, and we can help the client get to the goal they want to get to, right? We can help them get to that goal. Now, Alan Gassman did this unbelievable webcast several months ago, and if you email him or any of the great lawyers at Gassman Law, you'll see that he did a wonderful webcast that dealt with the Florida's recent adoption of a community property trust law here in the great state of Florida. And I would defer to him for sure, that he's going to know much more about that than I do. And I will tell you that I actually viewed it. I viewed the webcast when he discussed it. I remember seeing it because I said, oh, this is new and this is going on right now in Florida. And he'll tell you about what I call the good, the bad, and the ugly about that recent adoption of Florida community property trust law. So I would reach out to him. I really appreciate, by the way, all the work that Kelsey did, Kelsey Compton, on these webcasts, not only mine here, that Alan invited me, and I do appreciate that Alan invited me, but in addition, I appreciate all the work that they do every week for us, both in the Thursday report, and I read those things, I really do. And so those are useful to me as a Florida lawyer and a Florida CPA. Many clients are more interested these days in income tax planning because when you look on a macro basis at the number of people who will pay a federal estate tax, it's very, very few families that are impacted by a federal estate tax. They're more interested in the income tax planning. And so basis planning, we were just talking in the last segment about what's called reverse 8513, reverse revenue ruling 8513 planning. What's that? You set up an intentionally defective grantor trust many years ago, and you got non-voting S stock or family LLC non-voting units in there, or whatever. You might consider a sale of those assets out of the trust to the individual so you can get the step up in the basis if you'd like to plan into that. You might want to do what we call reverse 8513, reverse revenue ruling 8513 planning. That is something that they bring up at the Leading Estate Conference, which Alan goes to. I've actually said hello to him at the University of Miami Heckerling Institute. This year, Orlando got canceled. They're going to do virtual again, but we'll eventually be live there in Orlando again. About 3,500 estate planning professionals attend that every year. And so the bottom line is a lot of people are interested in the income tax side. Now let's talk about some potential traps and some potential things we have to be aware of. For example, Code Section 1014E of the Internal Revenue Code, the one-year rule. The way that rule works is if I give an asset to somebody and then they give it back to me through their will in a year, there's no step up or step down in terms of that. So we have an example of Obi-Wan. You know, I'm a Star Wars fan. Obi-Wan never told me about this. And of course, the client has to be Jabba the Hutt because that's the client that doesn't have any basis records and jewels all over the basis records, and there are no records. And the purchase cost was under the Internal Revenue Code Section 1012 in Jabba's land on Federal Highway in Del Boynton, another good old Seinfeld thing. $400,000 cost basis, fair market value is $1.6 million. The stepped up basis would have been under 1014 and $1.6 million. But again, if you have this trapdoor, you have to be careful of the trapdoor, right? So we want to be careful about that. Watch out for income in the respect of a decedent. Time to tell of famous income in the respect of a Decedent War Story. True story. Got a phone call from these very bright lady accountants, CPAs, and they said to me, we've been to your courses and this and that. We got a guy who died last week, and we want to know step up in basis. He's got a zero basis, and the sale is going to be several $1 million. I said, when did you enter into the purchase and sale agreement? When did your decedent client, and when did he enter it? Oh, many, many months ago, he entered into this purchase and sale agreement. And then all of a sudden he got sick, went in the hospital for about a month, and then croaked and died. Oh my, I said, did you read the Tax Management Inc. BNA tax portfolio on income in the respect of a decedent? This is called completion of material acts doctrine. And they said, what? I said, there's a doctrine out there and some case law that deals with this. And it says that if all of the material acts that were precedent, a condition preceding to the closing, if they had occurred, all you really did was put off a mere ministerial closing. There is no step up. I said, it's not a private letter ruling. We'll get into that in a moment. It's not a private letter ruling, but you ought to think about this. This is something you should think about. Go think about a private letter ruling. I said the good news is a couple weeks before that ruling comes down, they're going to tell you good, bad, or ugly what they're going to rule. You could retract the ruling, but they'll go audit you. They'll know who you are. They'll know what you were looking for. So it's up to you all what you want to do. Are you available for the ruling? I said I happen to be on the road. Back then I traveled quite a bit. And I was on the road. I said, I can't. And I told them about the ruling fees and the costs and all this other stuff. But my concern there is that income in the respect of a decedent, installment sale contracts, IRAs, this sort of thing, doesn't get a step up or a step down basis. Those are income in the respect of a decedent. Those are special items. If you read IRS publication 559, why do you want to know about IRS publication 559, decedent, beneficiary, 1040 income tax issues, fiduciary income tax issues? These are and that's a very important publication that IRS updates every year, publication 559. If you forget anything, you can't remember, my email address is here. Email me. I try to send you a link to an article or something that you need to know or whatever there, okay? So when those two ladies called me, I said, look, I said, I'm not charging you for this. So the advice is what you paid for it. I said, I would definitely either look at a PLR, look at that Tax Management Inc. BNA portfolio on the completion of Material Acts Doctrine and income in the respect of a decedent. I said that's basically like an installment sale. Now, as I said in the last segment, under Code Section 6001, that's a very important code section, because that tax code provision says we have to prove our items on our tax returns. And if you were to Google Schedule C sole proprietorship audits, up will come an audit records 2-page document that the IRS has about what kinds of records they're going to ask for, diaries and logbooks and calendars and cancel checks and these sorts of things. Very important as we're coming into tax season to know why it's important to cooperate with your tax return preparer and understand how to pick and vet a really good tax return preparer, right? And I teach a lot of tax return preparers, and I teach a fairly sophisticated, advanced type of continuing education to tax professionals. But that's how the government, if you read the documentation, that's how the government gets most people, is the people don't have the documentation. So they end up in audit saying, okay, just charge me the tax and the penalties and the interest. Now, there's a couple of new forms you need to know about. IRS Form 7203 that I discussed in the last segment with Chris about SCorp shareholder stock basis and SCorp shareholder debt basis. We're going to see a copy of that in a moment. That's a brand new form. In fact, the government even asked in an emergency memorandum for permission to go ahead and issue out this form and the form instructions, and this is now out there. This is now out there. And what it wants us to do is calculate the S-Corp stock basis and the S-Corporation shareholder debt basis. And what it wants us to do is to do that anytime there's losses or deductions on a Schedule K-1 for the S-Corp reported out to the shareholder, anytime there's a non-dividend, in other words, an ordinary distribution out of stock basis, they want to see the actual schedule. So now they're actually asking us on an actual form to produce that. That's brand new this year, brand spanking new. So if your preparer comes to you and says something about that, I just wanted you to be aware of it, right? The other form that's brand new is IRS Form 15254. Revocation of a 754 election. So one of those things when we do family LLC work and family limited partnership is we're figuring, okay, we got a commercial office building inside of this family LLC or inside this family limited partnership. If any one of the owners who are senior owners pass on to the great education course webinar in the sky, that we're hoping that we can get an optional basis step up in the building, and the building is depreciable in nature. And so we're hoping that one of the relatives who's going to inherit that unit in that family LLC, we're hoping they're going to get some additional depreciation off that item, that 754 election item. And so what happens sometimes is they come to us, the family, years later, and they go, there's a lot of costs with this thing. You got to have the lawyer involved, the CPA involved. You need a real estate appraiser, an entity interest person. Maybe we should get out all this cost. Maybe we should undo the 754 election. Now, 754 elections aren't made like the first year of the partnership LLC. they're made on either the first death or the first sale. They don't have to be made. It's an optional basis, an elective optional basis adjustment. So the question is whether to make it or not. That's in consultation with the CPA's attorneys, the client. But then if you want to get out of it, in the old days, you had to ask for a private letter ruling. You still can ask for a private letter ruling, but that costs a lot of money. So the government came up with a streamlined way a couple of years ago. They came up with this new form, and they say, great, this can be made on a form. And if you read the form, we're going to see the form in a moment. The form is great because the form has all the typical reasons you would go out of this thing. Why? The change in the nature of the partnership, the number of sales that are going on. There are a number of things in the private letter rulings that have been culled there by the IRS and put in the instructions to the form. So let's take a look at the forms just for a moment, and then we'll move on down the yellow brick road. This is Form 7203, the SCorp shareholder stock and debt basis limitation. This is the draft as of October. I do apologize to the audience. They did do an update to this. They actually put out December instructions, and now we're going to have final, obviously. And this is the form itself. On part one, you calculate the stock basis of the shareholder of the S. And in part two, they do the S corporation debt basis and the shareholder's debt basis, right? And as Chris and I were talking about in the last segment, we were talking that it's not like a partnership where you get partner share of partnership liabilities. Here, we're talking about direct economic outlay into the S-Corp, whether it be a proper back-to-back loan that like we were talking about, or just we made a shareholder loan payable with a promissory note. It could be open account debt. This is a very important form. It's a new form. And when do you do the form? That's, of course, what everybody always asks. When do you do the form? Bottom left-hand corner. You're claiming a deduction for your share of aggregate losses or aggregate deductions off the K1, including a carryover from the previous year. You received a non-dividend, not out of E&P, a regular stock basis distribution, and they want you to prove that it's coming out of the stock basis tax-free. They want to know if you received a loan repayment, because loan repayments, if the face amount of the open account item or the note is at full amount, never use basis in the past out of the note to write losses off, you can get a tax-free repayment out of the loan basis. But if you previously reduced the loan basis and now you repay it in whole or in part, there's an income recognition transaction. And so they want to know that. And then the government is getting real interesting. They go, it might be beneficial in the tip box to complete this thing every year to keep track of your basis in your stock and your basis in your loans, even though it's only required in the events above. So we know that this is a problem area. The American Institute of Certified Public Accounts, of which I am a member of them, their organization several years ago asked the government to consider a proposal that the government, the IRS, said no to so far. They said, why don't we have the QuickBooks preparer for the S corporation? Why don't we have them just every year update these schedules? And why don't we attach them to the K1? And why don't you consider that our beginning point here on the proof issue? That would have been great, because the QuickBooks preparer, whether it's cloud-based bookkeeping or not, they usually will do that as part of their practice of writing up the books of the business and the S-Corp. And that would have been great if the IRS had embraced that. So if you want to write your congresswoman or congressman about that, I'd appreciate that, because I'm one of these guys who's very practical about the U.S. tax law, because I've been teaching it so many years since the 80s. And the bottom line is that I really want to see some more pragmatism out there. And so this is going to be an interesting requirement under Code Section 6001 to prove up basis and file this form. How do you do that if your banks are merged out of existence, or you can't find the canceled checks? What do you do, right? What do you do? So this is the other new form that I mentioned, 15254, request to revoke a Section 754 election. And they want to know if you've ever previously done a revocation before, asked for one. Is there a substantial administrative burden on doing the 754 election, appraisers and time with the lawyers and the CPAs, et cetera? So they're giving you basically a roadmap to the reasons that they will allow you to get out of this. And then they're very open in the instructions and telling you that If you can't get it this way and you want to go do the old style private letter ruling approach, even though it's much more costly, you could do that. So this is an important form to study if you find yourself in that set of circumstances. Let me make a couple of comments about distribution planning. We're here is still in the 65-day rule. I don't know if you watched Alan's webcast last Saturday, but it was extremely informative. I tuned into part of it. I had some obligations, but I did tune into part of it. And the reality is, I heard him bring up the 65-day rule. That rule says that any distributions in the first 65 days, if we have a calendar year, trusts have to be on a calendar year. Estates can pick a fiscal year, but trusts have to be on a calendar year. And so if we have a calendar year, the first 65 days here, we might be making a distribution, and we might want to make a distribution because we might want to get the income tax out to the individual beneficiaries and not inside of the fiduciary income tax return. The Form 1041 fiduciary income tax return has compressed income tax brackets. You're going to pay a lot of tax inside that 1041. Now, obviously, you have to understand the instrument because the instrument controls everything, right? Whether it's a will for an estate or whether it's a trust instrument for a trust. And distributable net income is your governor. That's a tax code concept that is your governor of what can be distributed, both as to ordinary income, tax exempt income, and if the instrument and state law cooperates, capital gain as well, right? So there's two concepts here. There's distributable net income, which is a tax concept that has a taxable component to it and a tax exempt component to it. And then we have to look at the instrument, and the drafting's critical because the drafting controls the DNI taxation and the flow out, right, between the fiduciary and the individuals. Remember, the basic concept of fiduciary income tax is to the extent you retain fiduciary accounting income, that's state law accounting income, we'll get into that in a moment, and distributable net income inside the 1041 fiduciary return, you pay the tax inside of there. To the extent you distribute it, the general rule is the individual beneficiaries pay at their rate. So this is something that you and your accountant and you and your tax attorney and a trust and estate attorney can discuss, right? And this is important. Now, what is fiduciary accounting income? That implicates upon a lot of things. There's actually a statute in the Internal Revenue Code 643B, that's state law income. So if the instrument tells you how to allocate things between income and corpus principal, then you follow that. Otherwise, the state law that controls that particular entity, whether it be an estate or a trust, the particular state law involved, that's what tells us what goes into that particular solution. So we have two things we're tracking. We have fiduciary accounting income, state law income, what does the instrument say, and also distributable net income. And distribution planning is a critical thing between looking at the fiduciary, the 1041, and looking at the decedent heir beneficiary 1041. I'm sorry, 1040. I apologize. Residuary bequests in a will or a trust, they always carry out distributable net income. That's because under the statutes and the regulations they're not ascertainable with reference to the instrument at the time of death, because you might be allocating certain expenses against it and this sort of thing, right? So that's why. And we already talked about this, the 65-day rule. One more rule I want to talk about. Specific bequest of property or money. If you're drafting a document with your lawyer and your CPA, if you want to do a pre-residue bequest of a specific property or a specific dollar amount, money, that disengages the normal DNI distribution rules, and therefore they don't carry out DNI, which means that the money or the property goes out, but the person who's getting it doesn't have an incident of taxation on a Schedule K-1 for that item. So that's very important drafting when you're sitting down with your lawyer and your CPA and looking at that. That is a very, very important thing to think about. A few more comments. I know that I'm limited to 30 minutes and I don't want to hold you any longer than you have to. One of the things we look at is if we have a living trust at the time of drafting, which is very common here in Florida, and a pour over will that pours assets from the probate that haven't been pre-funded into the living trust, if it pours it into the living trust where the dispositive guts of the document are, right? We usually do what's called a qualified revocable trust QRT election. And the reason is trusts are forced to have a 1231 year, but an estate can have a fiscal year. And if you're not a taxable estate, you don't have to file an estate tax return of Form 706. You could do this for a 2-year time frame. And there are certain advantages and disadvantages of doing this. But this is something you want to look at and just something you want to consider. And I put a copy of the form in because even in the form instructions, they talk about why it might be good to file this and why it might not be good to file this. SCorp continuation might be a reason because an estate can own S stock, period, end of story. A trust, it depends on whether the trust qualifies or not, as Chris and I were talking about in the last segment. So that's one of the reasons. There are other reasons, but there are reasons pro and con. Now I want to talk about something that's near and dear to my heart. I talk to a lot of CPAs and a lot of lawyers, right? Because I'm a lawyer and a CPA. I teach continuing education. I also practice. And so I talk to a lot of people, and I'm just going to tell a couple of war stories quickly that illustrate how important it is to read your retirement plan documents, to read your IRAs. Please, there's 2 things you could do for me after this webinar that I would really, really appreciate. And if you send me an email that says you did this, you don't know how happy I will be. One thing you could do for me, I discussed in the last segment, please have a letter of instructions. That's not a will. That's an informative document that tells me what your email passwords are, what your online passwords. How do I get into your TD Ameritrade account or whatever it is, Schwab account, Fidelity account? How do I get into your IRAs? How do I get into all these things? What do you want? Do you want your granddaughter or niece and nephew to grow up to be an artist or whatever it is, right? These are what we call precatory, but they're informative, especially the email thing. That story is a true story from the last segment. The woman is sitting there over a Panera Bread, chopped chicken Caesar salad, telling me about the death of her first husband. I don't think she got remarried, but first husband, and about how there were no passwords to get into his SCorp accounts, and his SCorp had to be sold for $10 because they couldn't hack into his online accounts for the technology for his SCorp. It had to be sold for $10. How many of you have a roadmap? You don't understand. Yes, Gmail has a privacy manager where you can go in there and say, okay, I give the permission of the following person to get in there. Digital assets estate planning is what they call this, by the way. Digital, you could Google digital assets estate planning. And yes, Florida, we have digital asset laws. You could put in your documents. Okay, I want this to go on, that to go on. But you want to have an information letter. If you can't find a format, you email me at taxman532@hotmail, taxman532@hotmail, just like the Beatles song, Taxman. And you email me, and I'll try to find you a format out there and send you a link and say, please do this. Please read your IRA documents. Please read your beneficiary forms. Please read your, now we're going to tell a couple of war stories, tax deferred annuity. So I was friendly with this woman who was the mother of one of my friends at the time. He was a professional person. We knew she had lung cancer. So we knew she was in the hospice at home. So we knew that she had limited time. I was actually teaching in Detroit, and he called me up and he said, Mom passed on. I just had lunch. My mother, may she rest in peace, and me and their family, we had lunch together. It was Memorial weekend, and she passed on. And so I said to him, I'll go ahead. I know her. I'll go ahead and take care of the probate. And if you need any support, let me know. And he did call me and he says, the broker told me the following about this tax deferred annuity account. He told me I have to take the money now, or I'm stuck with the 5-year rule. The 5-year rule is a default rule that if you don't name what's called a designated beneficiary at all, that's the default rule. Pay it out by 12/31 of the calendar year that contains the 5th anniversary of the date of death. That's a very short payout period. So I said to him, do you know how to read these documents? He says, no. He says, do you? I says, yes. And he says, I'll get you copies of everything. Okay, fine. So I took my mother out to San Francisco for a little break, and I was sitting, we got delayed by a hurricane. So I'm sitting there with my typical orange and pink highlighters. And I said, the stockbroker didn't tell you about a rule that's in here. You see the document controls, right? So I said there's 3 rules in the document. You could take the money in the year after death. That ruins all the deferral. You could use the default 5-year rule, or you could take a life expectancy path. It's like an inherited IRA. It's like you're a surviving wife. You could leave it in the name of the deceased husband, and you could take as a beneficiary, and you could take over a life expectancy payout. That's a long deferral. You could take more than the minimum distribution, but you got to take just the minimum, and that's a stretch. That creates a stretch. We'll get into the whole issue of the new law, the Secure Act law that just came out a couple of years ago. Bottom line was the broker sat there with us at the side table when I came back, and he calls up the company that sponsored the document, and they said, that's a sharp lawyer. He knew what he was talking. I said, all I did was read the document. And I said, it's important to understand what your options are in a post-mortem fashion after the death of the owner of the account. So what really makes this interesting is that we now have a new law that came out a couple of years ago called the Secure Act that forces a new 10-year rule at us in certain circumstances. So what I did to try to keep it plain English for you at page 26 is I sent you in the PDF the inherited or stretch rules under the Secure Act, what they call the eligible designated beneficiary rules. We are waiting for regulations. The regulations still have not come out of the Treasury on the law, but we do have the guts of the law. And if you go to the American College of Trust and Estate Counsel website, they have a couple of short podcasts. One is by the leading expert in the country, in most people's opinion, Natalie Choate out of Bingham. Well, she used to be off counsel at Bingham in Boston. She's probably the leading expert, Natalie Choate, Choate. And she has a nice PDF up there that you could read. It's about 80-something pages long that updates you on the Secure Act rules in plain English. And she does a great job on these. And you should really read this. Eligible designated beneficiary that's available for what they call a modified stretch, a modified deferral, would be surviving spouse, which is the most common naming on a beneficiary form. That includes a trust format for the benefit of surviving spouse, drafted properly. And then we have minor child of the participant or trust format that qualifies thereof. Then we have chronically ill beneficiary. And then we have disabled beneficiary. And one of the reasons we're waiting for regulations is we want to know how to draft those trusts clean, right? And they also have a multiple party chronically ill disabled. And so we want to see how they want us to draft that. And then somebody who's named as beneficiary who's within 10 years of your age, or the owner of the account. So that could be, for example, a sister or a brother, right? That would be very, very common to see. And so here in Florida, we see this all the time out there. So the stretch IRA, people say it's dead. There's a modified stretch under the eligible designated beneficiary rule. And if you're really interested in reading about this, you could look at IRS publication. There is an IRS publication. The IRS publication is 590 capital B. There's 2 590s. There's a 590A that's putting the money in the IRA. And then there's the 590 Cap B taking the money out of the IRA. And if you're interested in retirement plan distributions, there's an IRS publication 575. There's a 575. There's also ones on 403B, et cetera. Again, if you get caught in this and you want me to send you a link or something, again, email me and I'll try to be cooperative and helpful. It is busy season, but I'll try to do what I can do for you out there. By the way, inherited spousal, big issue, right? We had a woman in Alaska, very bright CPA. She had a client. He was up in his 70s, wife was in her 50s. He died in his 70s. So the question was, roll it over to her account, roll it over from his 401k to her IRA, or do an inherited, etc. And so we did figure out a way to do what's called an inherited 401k, which you could do that too. You could also do what's called inherited IRA, and that means you could take money out of the account, pay income tax on it, but no pre 59 and a half 10% penalty tax, right? So remember, she's under 59 and a half, he's way over, he's in his 70s, right? So that happens, we see that all the time, right? So publication 590 Cap B is mentioned on the bottom right hand corner at page 27. You might find that useful. I mean, I could tell more war stories. I'll tell you one last war story. I was teaching in Kenner, Louisiana. That's a suburb of New Orleans. And there's a woman in the audience, and she says, you better read your documents and your beneficiary forms. The following was in a beneficiary form and an IRA document. It said that, let's say we got Ozzie, and Harriet died 5, 6, 7 years ago. So we got Ozzie, that's the husband, that's the father. And we got 2 children, Ricky and David, if you remember the old show. Ricky and David. And let's say Ricky has 2 children and David has 2 children. So the question is, if Ozzie dies now, but Ozzie dies after Ricky. Ricky died in an airplane crash after he's freebasing cocaine. You remember that. So that you'll remember the old story. So the question becomes, when I do this case study, when I teach, who inherits the account? Is it inherited by David, or is it inherited half by David and half by Ricky's children? Is it a per stirptural distribution, follow the lines of lineage, where Ricky's children would step into Ricky's shoes as to Ricky's share, or is it David? And she read a document that said everything to David unless you indicate otherwise. So that's why you have to read these things and understand them and talk to your attorney locally there and talk to your local CPA and your attorney about these kinds of things, right? Because that's going to be a very interesting issue if you don't read these documents. All right, a couple more comments and then we'll finish up. Charitable contribution substantiation. I purposely made the PDF shorter. I could have stuck a whole bunch of things in here on charitable. And Alan has just done some unbelievable webinars on charitable that are on his YouTube channel. And if you could get a chance to see some of these things, they're really, really, really good. I've attended some of the charitable stuff, and I have a passion in that area, so it's interesting. This is IRS publication 1771. This is what they give the temples and the churches and the mosques and the 501c3 tax-exempt organizations. Here's what you have to give your patron as substantiation. So we saw a case back, what was it, 12 Durden, where this nice tithing, church-going tithing couple was giving money, but they didn't have the no quid pro quo language on the substantiation. It has to say on the substantiation, it has to say, no valuable goods or services were received in exchange for this charitable contribution. It has to say that. That's required lingo. And it didn't say that. So they got this IRS audit notice. They contacted the charity. They said, it doesn't say that. So then they got a new set of substantiation from the charity, and the government said, it's not timely. It has to be contemporaneous at the time. Like right now, this time of year, in January, you'll get from the 501c3 tax exempt org, you'll get the substantiation, right? And so they're saying it wasn't like that. It was done because they knew they were getting an IRS audit examined. So this is a very short 9-page pub, but it's well worth reading as we come into tax season about, do you have the right written communications acknowledgement of any single contribution, $250 or more? Did you have anything that said you got any goods or services for a single payment in excess of $75? Like I had a lady friend, she did a benefit concert for the Parkland. We're right near here, Parkland right here. And she did a benefit concert, and they were getting stuff in exchange for it. So it had to be disclosed on the statement. So her CPA was doing the statements for her. And that CPA was doing that, was putting that information on there. So that's very important. These record keeping rules and the written acknowledgement and the contemporaneous requirement that we saw in the Durden case, very, very important thing. The other big thing is non-cash charitable contributions, right? The fact that you have to have qualified appraisals. We saw on the webinar a couple of weeks ago with Alan Gaspin, a brilliant lawyer, Carl Mills, and he was talking about cryptocurrency. And he was talking, because I watched it, he was talking about cryptocurrency, and he was talking about charitable contributions of the crypto and about the qualified appraisal rules. And those are very nitty-gritty specific rules. And the instructions here to the Form 8283 actually get into those rules. And there is an IRS publication, just if you want to make a note of it, there's an IRS publication 561. And the IRS publication 561 actually discusses those qualified appraisal rules. Now remember, the qualified appraisal rules come up in two contexts. They come up in gift tax returns, they come up there, and they also come up with non-cash charitable contribution Form 8283. And the reason I'm bringing it up is I teach tax updates, and when you look over the years, right, you see patterns, right? So you know that the IRS does correspondence audits out of Ogden, Utah on charitable, right? You see this all the time, right? Really important. Now, by the way, the two pubs that are critical at page 42 on the right-hand side is pub 526. That's the general IRS publication on charitable contribution. And then publication 561, right? And they're bringing up the 170 cap A rules, the regs there. That's the qualified appraisal rules. They're also discussed in this particular form instructions, and they're discussed as well in the 170A reg, and they're discussed here in these instructions. By the way, I don't know where you're viewing us from, but qualified conservation easement deductions, charitable deductions, they're auditing that. They even have an IRS audit technique guide on the issue, and they are really looking at that big time. That's a big time thing. So I would encourage you to understand that. I did say I would stay roughly to the 30-minute time frame. This is my LinkedIn account. It's Lawrence J. Stein, CPA, JD, LL.M, CFP. That and $3 will get you a cup of coffee at your local coffee shop. But if I can be helpful to you or your family, you have my email on the front end and you have my address in Boca there, Boca Raton, Florida. This is my LinkedIn at the tail end that I stuck in at the tail end, just in case you want to link with me, and that's a good way to chat with me sometimes. I do appreciate all of Kelsey's work, all of Alan Gassman's work, and Christopher D. Nicola. And I really appreciate you having me on today and listening to me. Thank you for having me, and have a great day.